Good morning. Welcome to Almus Market Morning. So we had a slump in the global stock market yesterday after the yields made new highs in countries across. Mainly the US 10-year yield and 2-year yield shot through their major resistances. And Nasdaq dropped about 2.5%, and it's now about 9.7% lower from its all-time closing high. So 10% is a kind of normal correction, but from the look of the charts, I feel maybe there may be more fall to come. In fact, Nasdaq has closed below 200 DMA, which market watches very closely, and it's closed well below that. So more vulnerability on the stock market because yields in Asia are even higher today at 1.89 10-year and 1.07 2-year. German yields are almost at par now. That's another development which is prompting sell-off in the bonds. For the currencies, it was a very volatile day. Euro sold off along with other low yielders, despite German investor sentiment hitting its highest in 6 months in January on expectations that COVID-19 cases will fall by early summer, allowing growth in Europe's largest economy to pick up. The move in euro is also surprising because Eurozone 10-year yields also steadily moved towards positive territory, which is a big development. I feel the euro's downside would be limited to 1.13. Yen also split against the dollar after Bank of Japan said it would maintain ultra-loose monetary policy, while many were expecting them to indicate some sort of tightening mode. Japanese currency later on recovered due to two reasons. One is the risk of sentiment, and secondly, also the fact that the Bank of Japan updates inflation forecasts. Overall, since inflation is a global problem, Fed cannot be hiking a rate much faster than other central banks. So it's either we see other central banks catching up or Fed going slower on rates. Either way, dollar upside based on rate differentials should be limited. It may play out until the risk of sentiment is there, especially against the current low yielders, which may actually turn into slightly better yielders. We may see dollar not so strong. However, against emerging market currencies, which are yet to react in a big way to these steep rising yields, dollar may post more gains in the coming days because the financing cost will be going up, and investors will have to borrow at higher rates to invest in the emerging markets. India stands out as an economy where the central bank still maintains an accommodative stance, and expectations of a near-term rate hike is very low, whereas many EMs and a few developed countries have or are raising policy rates. This will be a disadvantage for the rupee from a global investor point of view. The rising global financing cost will also affect flows into India in the months ahead. With the trade deficit, high oil prices at multi-year highs, and questions arising about investor flows, rupee looks vulnerable for more weakness for some time. However, the balancing factor would be the long-term investor attitude about India's growth potential, as well as the large IPOs which are possible in the coming months. Apart from LIC, also hearing about a few other large IPOs. So at some level, we should start seeing greater interest from these investors as and when these IPOs are announced. Technically, USD looks poised for 75.10 in the coming days. Thank you.
Thanks, JK. I think Wednesday, 26th Jan, the speech is very important, and that will probably might change the wind. The wind directions look like already changing. So all market segments now seems to be in the risk aversion scenario. when US Treasury yield curve is at the higher than the pre-pandemic levels. So entire US yield curve is now moved north than the pre-pandemic level. I'm talking about US. Now, this led to a higher move in USD index also, which is dealing at 95.75. I think USD dollar index is entering into resistance area of around 95.80, 96 levels. And FOMC announcement will be coming on 26 Jan, and USD index still move in the range of 95 to 96 half. If it takes out 96 half before FOMC announcement itself, then it looks like a big move for a dollar in dollar interest. US 10-year yield is dealing at now 1.89, and it looks like it will be capped by a psychological and technical level of 2%. Not seeing a move edge of now higher than 2% for next till FOMC meeting, even people are preparing for aggressive FOMC. Interestingly, RBI released its monthly publication on 17th, day before, and the outstanding net long forwards are around $49 billion, and these are all maturing within 1 year. So net long forwards are $49 billion. This is as on November 30th. I don't think so in December they would have done something. Even if they would have done, it could be 3-4 billion. So max, I believe $45-46 billion of our long forwards, in addition to $630 billion of our FX reserve. Now it seems that there is ample ammunition to deal currency exigencies. The better part of India is that last 3 years we have not got much investment in debt side. G-Secs and corporate bonds have not seen much of a FPI inflow. So even if the things go worse from these levels on the interest rates, at least we will not see outflows from the bonds or much. Now coming back to another variable which keep hitting dollar rupee or rupee is a crude oil. Now crude oil, both crude oil, leading crude oil, Brent crude oil and WTI crude oil, which are dealing at a 7-year highs. WTI is 88.57 and Brent crude is 88.57, WTI is at 86.65. Now important to look at these levels. The corrections of a 2012 to 2016 correction have started, and it can easy, the first target would be looking around $90 to $93. So the crude oil scenario is not looking good. It will impact rupee. Now coming back to Indian bonds, 10-year G-Sec old and new both bonds are now dealing around 662. And in my view, they are headed further northwards. Thank you. Thanks a lot. Have a nice day.